Hold on. I know some of you absolutely hate how long my intros and shoutouts are and only want the data. So to you people, I say, please come back in 1 minute while this plays. And I can promise you guys, you're going to see some of the most eye-popping, data-driven, and value-laced live I've ever done. So happy Friday, and I'll see you in 1 minute. If you didn't make that cut, I apologize. There will be more. I absolutely appreciate all of my core subs. I know I missed some people. I couldn't fit it in there. But you guys, we're going to start today by taking a look at all things interest rate. And you guys, I'm not kidding you. This is going to be a live where you see things you've never seen before. I went all out today. That's why I have this vest on. Thank you for noticing. Don't move. I noticed your comment. But I want to start here, you guys. I want to start by talking about the refinancing volume, because quite frankly, the people right now that are refinancing, cashing out, those are people that are potentially going to be forced to sell as a result of unaffordability, because obviously, guys, when they refinance and cash out, not only are they pulling out their equity, raising their mortgage payment, but they're also trading in their low interest rate, which is essentially allowing them to go from golden handcuffs to horrible, real life criminal handcuffs. Now, this is very interesting. I wanted to bring this report up where we start here. And really, this is a comparison to mortgage rates versus refinance volume. And really what I want to point out is this. I want to point out from 2016, where my mouse is right here. You guys should be able to see that from 2016 to 2019. I just wanted to go on record and I wanted to point out, you guys, that interest rates were averaging about low 4% to high 3%. Do y'all see that? And yet the volume of refinancing was relatively low, okay? But what happened, as you guys can see here, is realistically, guys, I want to make this point as well. Interest rates before lockdowns were 3.72 on average. So literally interest rates, when I look at this, they only went down 1.5 points. So you're going to tell me interest rates went down 1.5 points and we were locked down for what, a year? And now we're in this mess forever? I don't think so. But what I want to point out, guys, is really how desperate people are getting right now. People are starting to feel the effects of these increased interest rates and quantitative tightening. And you can see that on this chart, okay? This like dotted line that's shooting up right here, you guys, represents 30-year fixed rate mortgages. Okay, so 30-year fixed rate mortgages have ballooned up, yet the refinancing refinance cash out is going up. So let me scroll down here. And let me show you just how bad the refinancing is right now. So this is the percentage of cash out refinances as compared to mortgage rates, all right? And what I want to point out is with the interest rates shooting up, again, the blue line is interest rates, okay? The gray line is the total share of cash out refinances. So say there's 100 refinances, 74 of those refinances are for cash out purposes, which is essentially meaning, most people, maybe not all, maybe there's some investors and whatnot. And this is not HELOC. This is actually refinance. These people are struggling. And notice notice how it corresponds to increased interest rates. So in essence, guys, this is what I'm saying. The higher the interest rates, the more people are feeling the effects of the unaffordability and therefore need to cash out. So like remember I talked to you guys about this at the beginning of the year, that box of people that are being flood in, the risk box. This is a risk box. So not only the people that are currently purchasing real estate right now are, tremendously at risk, also the people that are doing cash out refinances are also putting themselves at risk. So we have two things at play: recent purchasers and people that are doing cash out refinances. Right now, the share of refinances, 74% of those refinances are cash out refinances. Okay, so just wanted to point that out. Also, take a look at this, guys. This is the 15-year. This is basically saying no one's refinancing into 15-year right now, even though refinancing into a 15 years is a great idea because you save an overwhelming amount of interest. You're not going to refinance from a 3% 30-year fixed to a 6% 15-year fixed. And this is why it's plummeted. I'm telling you guys, what's going on right now is crippling people. But look at this, okay? Here's the stats, all right? If you guys want to know how many people just traded up their low interest rate to their high interest rate, here's the chart right here. Here's the additional homeowners that just put themselves at risk. Now, this is May to May. And really what I want to point out is these are only counting loans that are Fannie Mae and Freddie Mac. Not all loans are Fannie Mae and Freddie Mac, but most loans are Fannie Mae and Freddie Mac. So I wanted to point out, you guys, in the last year, or at least going May to May, this is how old this data is, there was approximately 681,000 homeowners. Again, 681,000 homeowners. These are old homeowners. These are not recent homeowners, okay? You have to have equity to refinance. The new homeowners don't have equity. These are the well-positioned homeowners, or once well-positioned, you guys. 681,000 households in the last year from May to May traded in low interest rates for high interest rates, essentially overexposing themselves, unless they're making money with the cash out, which I doubt strongly that they are. So not only are we going to keep an eye on the recent purchasers, we're going to keep an eye on this cash out refinance nightmare that's going to take place. So moving on to our next chart, you guys. Here's the statistical averages on what people are doing right now as far as purchasing or refinancing. Okay, this is basically a national average. Now, this is way more up to date. This is as of July. And I just wanted to point out, just so you guys have this information, right now, the average credit score is actually not bad. It's 730. Also, the average LTV is 80.68, which basically means, you guys, the average down payment is 19%. According to stats that I reviewed during the great financial collapse back in 2007, 2006, the average down payment was 25%, which means right now people are putting less money down. Now, an interesting question someone had for me yesterday was whether or not that statistic included second mortgages, because back in the day, everyone was doing second mortgages. And the thing is I'm not 100% sure. Let me show you guys this next thing right here, okay? Now, this right here, you guys, is important because this is the relationship between 30-year fixed rate mortgages and the 10-year treasury, okay? And this is why we've been watching the 10-year treasury. It's this right here. So you guys can see basically this blue line is the 10-year treasury. The orange line is 30-year fixed rate mortgages. You guys can see it almost tracks identical. Y'all see that? So again, I just wanted to point out another reason why we're watching that 10-year treasury, all right? Now, let me show you guys where we're at. Oh my gosh, this is insane. So here's where we're at, you guys, with the 10-year treasury right now. It's actually up 4 basis points. This is crazy. We had some news come out this morning about the jobs. I'm going to get into the jobs here in a minute. But again, this is why we're watching the 10-year treasury, not the federal funds rate. The federal funds rate does not track mortgage rates. This tracks mortgage rates. You guys can see it's up 5 basis points today. But the really crazy thing is, if you look at this chart here, it actually plummeted right when the job numbers came out. So job numbers came out. This actually went down a substantial amount, actually. This was actually down when I was preparing for the slide. I didn't know this went back up, actually. It's surprising to me. But this swung about 10 basis points because it was down about 5. It's now up 4. So that's really, really interesting. Now, let me show you guys the effect that's having on mortgage rates right now. So here's where we're sitting with mortgage rates. You guys are sitting at a 30-year fixed rate average of 7.07%. Obviously, now that 10-year has gone up a little bit this morning, we're probably going to enter the 3-day weekend interest rates, again, in the low 7%, probably 7.15 or something along those lines. Let me show you guys also, okay, how much you qualify if you're the average person. Okay, so the average American makes what, 80,000 is it, or is it 82,000? I'll put 82,000, okay? Average American makes $82,000 per year. We'll say we're going to put them on a 30-year fixed rate mortgage. The current interest rate of 7.07. We're going to take the average debt. Okay, that's the average debt. It's $1,400 a month. That's average with a used car, not a new car. $1,400 a month. You guys, I can't tell you how much that $1,400 payment destroys, absolutely crushes your purchasing power. So make sure you're not in consumer debt, because if you are, you're destroying your purchasing power. I'm going to give you guys a before and after. So the average person, 82,000. Average person, $1,400 in debt payments per month. Let's calculate how much the average person qualifies for. Look at this. The average person in America qualifies for $213,000, which is essentially half the average home in America. This is why we cannot stay in this situation for very much longer. This is why I'm saying it's not sustainable. The average American can only qualify for half of a house right now. Now, granted, you guys, that's in, assuming that $1,400. So let me show you, when we remove the $1,400 debt payments, like credit cards, car loans, and school loans, it goes from $213, look at this, guys, to $391. Do y'all hear me on this? So the average American, if you make the average salary, that's fine as long as you're above average when it comes to paying off your bills and staying out of debt, because you can see your purchasing power went up, what, over $140,000 because I don't have consumer debt. Do y'all see this? Do y'all see how powerful consumer debt is and how much it destroys your purchasing power? I hope you see that. It's right here, okay? You guys can access this yourself as well. Now, we're going to go into the next thing, you guys, which is a lot of bit bonkers, okay? That was the interest rates. I'm going to put a timestamp for the prices that we're going to go into right now. So let's go into prices. Here's prices. I'm using FHFA now, HPI. We normally have been using Black Knight or Redfin or whatever, but we're going to use this right now because FHFA has their own way to calculate prices. Now, this is going, what is this? I think this is for up to Q2 of this year. So this is up to Q2 of this year. And here's where we're at as far as year over year values. Now, we have had a rebound this year in prices, in which is completely spectacularly toxic. It is unbelievable. But I also want to point out that even though we had this insane rebound this year, and I didn't see that coming, to be honest with you, half of the US, not half, but the entire West Coast of the United States is still a statewide average, not county, a state, entire statewide average is down year over year. So you guys, we know that it takes 6% roughly to sell your house, 3% to the buyer's realtor, 3% to the seller's realtor, plus 2% in closing costs. So look at this. There is literally no state here that has 8% year over year growth. All right. And all of these states that average, like, for example, Nevada is in the worst shape, which is surprising because of how messed up California has been. But Nevada is in the worst shape as far as the state total. Nevada is sitting at a total year over year, the entire state decline, according to the HPI, of 5.3%. When we add the amount it takes to sell your house, Nevada is down double digits year over year, according to the data. Now, what's interesting is when we go to the right of Colorado, it stops, right? Except for DC, we won't even go into DC. But I wanted to point out the next at-risk state is Texas. Texas is at risk, the biggest at-risk of state that's currently positive to going to negative. So it's most likely that the next state that goes negative year over year overall is going to be Texas, followed by maybe Louisiana, maybe Tennessee. But look at Florida. I wanted to point out Florida is not as strong as it once was. All right, which what I'm talking about is last year. It's cooling. Things are changing right now. I find it's pretty astonishing. You guys want to see something else crazy? Look at this. Okay. Look at this, you guys. Just in case people don't understand what we're talking about, look at the bubble. This is the bubble, okay? We're comparing now. Again, we're using their value calculation, monthly home price index from the US. This is the HPI value calculation. We've never went over this on my channel. This is new data. Look at the run up here. This is the run up from the last great financial collapse. See this little tiny little bubble, the little baby bubble right here? This destroyed us, guys. This run up was, I mean, obviously the non-qualified, subprime and things like that. But look at this run up, okay? This is a baby bubble compared to this. Do y'all see the difference in run up and bubbles? We have a way worse bubble. This bubble right now is bonkers, you guys. It's 100% bonkers. If you agree with me, please, you guys, type in bonkers. I've never asked you to do that. Can you just type in bonkers to make sure that I know you're tracking with me? I need to know that you guys are learning something, at least something on each and every one of my videos, or I'm stopping. My goal is to empower you. We need to all evolve. So I hope this data is allowing us additional perspective and awareness, but look at the bubble run up. Insane, you guys. Absolutely ridiculous. Thank you, guys. I love you too. I see the bonkers. In my heart is fluttering right now. My heart is going bonkers right now. But let's look at the next thing, guys. Another look, okay, at the run up. This is the cumulative monthly house price change relative to the peak. Here's the peak in 2007, okay? And I want to point out, to get back to the peak in 2007, how long did that take, guys? About 7 years, all right? So, things take time. Things take time. We know that. We have historical precedents. Things take time. But again, look at the run-up. The run-up can't be disputed. Would you guys agree? So anyways, let's go into the next thing right now. Let's see, you guys. I'm trying to go like really quick here for you. I can't remember what we're going to do next. Oh, yeah. This is insane. So I get a lot of comments that say we're going to be okay, that the values of houses will be normalized because of supply and demand. And just look to the 1970s and 1980s, because in the 1970s and 1980s, home values from 1970 to 1982 went up 150%. And actually, in some years, it outpaced the stock market. Only difference is, though, back then, if we're going to compare it, wage growth was almost double what it is now. Wage growth back then was almost double digits. So we don't have the same wage growth. And the savings rate back then was out of control. People used their money for down payments back then. There wasn't 3% down payment loans. But one thing that is really, and then also assumable mortgages, we don't have that anymore, right? Back then, they could trade assumable mortgages like baseball cards. But the one thing, to me personally, that was a huge slap in the face when it came, Vegas, I love you. I see your super chat, brother. I'm going to try to get into this. I'm going to get to that, but I want to get to this data. The one thing, you guys, when I compare the 70s and 80s to right now that really slapped me in the face was the PE ratio, or rather prices to earnings. I understand payments are ridiculous, but this entire time of the existence of this channel, what have we been wanting? Lower prices. Take a look at the PE ratio. Here's the PE ratio right now when we compare what was going on in the 1980s into right now, you guys. So what I'm trying to explain is the reason why the 70s and 80s value was sustained, we don't have those ingredients today. Those ingredients aren't here. It's way more toxic than the 70s and 80s. Plus, I know we shouldn't compare what happened 50, 60 years ago compared to what's happening right now. But I do find it's interesting to look at the PE ratio because that's the wake-up call. Back in the 1980s, even with 18% interest rates, the PE ratio is 4.69, only for, thank you, I saw your comment, so flattered. I'm going to be 40 this year. I'll take all the comments I can get. Never mind about that. You guys, 4.69 PE ratio. Fast forward to today, look at, we've never had a PE ratio, which is the price compared to earnings, okay? We're not looking at payment to earnings. We're looking at price to earnings. We're at 7.76. Even in the housing bubble right here, the great financial collapse, we were at 7.03. We have a worse PE ratio than we've had ever. Was that fair to say? Ever? PE ratio, P ratio is important. P ratio is part of fundamentals. This is freaking insane, you guys. So I thought, I really like that chart, to be honest with you. Hopefully you guys like that chart. We're going to move on to something that, oh my gosh, this next segment is about the recession. I'm going to show you guys additional indicators. Now I'm going to show you guys 4 indicators, not just the 10 and the 2 year. In fact, you know what? In this segment of the video, I'm not going to even pull up the 2 and the 10 inversion. I'm only going to pull up things that we haven't been talking about that are signaling recession, starting with, let me throw this up, industrial production. Let me get out of the way here. Sorry about that. And we're going to look at some new data as well you guys have never seen before. So here's industrial production, you guys. Now, oh my gosh. I mean, this is so crazy. Now, this data goes back to the 1950s. Now, Jeff, I hope you're paying attention here because I know you're in a market that's tight. But when we look at all of this data, and I know you're in a tight market, it's like, man, something shady is going on, right? Something bad's going to happen. We haven't even paid the price yet. We're starting to, and I'll get to unemployment in a second. But look at this. Going back to the 1950s, okay, industrial production went negative. So we're looking at the line dropping below the red line. We're looking at the blue line dropping below the red, okay? Going back to the 1950s, when it dropped below the red line, it signaled that we were already in recession. This is an indicator that we are already in recession, okay? Now, obviously, the game book has changed because of the money printing. We've never gone through this before, and obviously, the stimulus was printed to the consumers, and I understand all of that, but nevertheless, this is an indication we're already in recession because going back to the 1950s, almost every time we've been negative with industrial production, this is in the industrial production index, year-over-year change, we've already been in recession. I think it's important to take this into consideration. Now, I know there's a lot going on, but look at, again, 1950s, you see that, recession. Here, we had a little false positive, so it went negative, went back up, and then boom, went straight down to recession. Same thing here. Same thing here in the 1970s. Same thing in the mid-1970s, 1980s as well. 1990, the year 2000, obviously the great financial collapse, the little tiny baby recession we had in 2020, and take a look at where we're at right now. Now, we may not be in recession. Maybe we start recession the 4th quarter of this year, maybe the 1st quarter next year. At this point, you guys, I don't know what's going to happen. I don't know if they're going to bail out the next black swan that's going to happen tomorrow like that happened in March. But I can tell you right now, if we look at industrial production index, it's signaling to us we may already be in recession. Something to consider. Let's look at our next data set. Okay, this data set right here. Oh my gosh. You guys, I watched Rebel Capitalist yesterday, and he pulled this up, and I was like, oh my gosh, another data set that says we're in recession, right? By the way, I love that channel. Now, here's something that is really cool. You guys have not seen this on my channel. Okay, this is called, let me pull up this right here. This is called GDP plus, okay? This isn't GDP. We already know, well, most of us know that they're cooking the books, for a lack of better words. Or maybe that's the perfect word, but this is GDP plus, okay? So not real GDP, not GDP, GDP plus. You probably never heard of this before. Now, this is a measure of the quarter-over-quarter rate of growth or real output in continuously compounding annualized percentage terms, which basically just means it's another indicator of recession. Let me show you guys where we're at. Now, I've went back to this data set. Okay, let me move my picture. My head's always in the way, but not as much as when I was young. Man, my ego when I was young, you guys would have hated me. Anyways, we're going back to the 1970s, okay? And I just wanted to point out that generally when GDP, again, this is called, so you guys one more time, GDP plus, when it goes negative, that generally means we're going into recession, okay? So let's go back. Let me show you right here. 1975 went negative, signaling we're already in recession. This is another, we're already in recession. So we went over one already in recession, which is the industrial production. Now we're going over our second, we're already in recession, which is GDP plus. So this is a warning, hey guys, you're in recession right now. Going back to 1974. Now, what's important to understand is the black line is GDP plus, okay? So we're looking at the black line here. So you see 1974, black line went negative, boom, we were in recession Intriguing. Same thing right here, you guys. 1980, boom, black line went negative, or GDP plus went negative. We were in recession. Same thing right here. 1981, oh, black line, GDP plus went negative, boom, recession. I hope you guys can see the recession. Same thing right here. 1990 went negative, boom, we were in recession. Perfect, right? Perfect history so far. No false negatives so far. Same thing in 2000.com bust, right? Negative GDP plus, boom, we were in recession. Also, great financial collapse. Wow. Even then, GDP plus went negative and recession. And I also want to point out, real GDP did not show negative. Only GDP plus showed negative. Interesting, you guys. Now, there was a false positive in 2012, but barely. Okay, so there was a slight, we got one false positive. One false positive, but we fast forward again to the last recession. Look at this, guys. Is this data not amazing to you? How many warning signs do we have? How are they going to soft land this thing? We have so much data. There's what's going on is there's just not enough time has passed, in my opinion. But let's go fast forward to today. Right now, okay, now it has rebounded, but as a Q1 2023 and Q4 of 2022, both GDP plus and real GDI was negative. Do you see this? So now it's went positive slightly Q2 of 2023. So I wonder when we have the numbers from Q3 of this year, I don't know how good that's going to be. I wonder if this is going to be negative as well. This is just another data set, you guys, that I want you to pay attention to that will warn us of recession. This is called, once again, GDP plus. Looking at our third recession warning. Here's our third recession warning right here. This is not the 10 and the 2. This is the 10-year and the 3-month treasury, okay? Statistically, this is more accurate to look at than the 2 and the 10. This is more accurate. This is pretty much confirmed that we're going into recession every single time. Literally, you guys, we have historical precedents that says we are 100% guaranteed a recession based on historical precedent. Now, maybe they'll try to print that away, but right now we're talking about historical precedent. This is the 10-year and the 3-month. And again, going back to the 1980s, look at this went under the black line, which means it inverted. And then shortly after, recession. Inverted right here, early 2000s, recession. Inverted right here in the great financial collapse, which I want to point out that inversion happened mid 2006. So even though that inversion happened mid 2006, me and a lot of other people were like, nah, home prices have only gone down once in the Great Depression. We're fine. But we were wrong. We weren't fine. 2 years later, we went into recession, and personally, I lost everything. We have so many economic warnings right now. It's crazy, but people want to hear what they want to hear. And look at, again, same thing happened right here, and then recession. But I just wanted to point out to anyone that thinks that we have a super strong economy and a tight labor market and strong GDP, look at the depth of the inversion. The depth of the inversion on the 3-month and the 10-year right now is, it's completely out of control. It's, looking back, almost 50 years, 41 years, it's never come close to this depth of inversion. What's going on right now, you guys, is absolutely unprecedented. Let me show you one more thing. Okay, take a look at this. This is M2. Okay, last time. First of all, M2 is the total money supply in the United States. All right, so really important to watch the money being burned. The Federal Reserve is doing quantitative tightening, which is basically burning money out of the economy. The last time that we had M2 go down while the Fed was doing quantitative tightening, do y'all know when the last time that was? The Great Depression. So now we have an indicator now that is warning us of significancies that we have, headwinds rather, that we haven't seen since the Great Depression. Some food for thought, you guys. Again, this is M2. This has been going down. Now it has been floundering since about May. So it has been floundering since May, but it has gone down sharply. That's huge, you guys. That's absolutely shocking. We have an overwhelming amount of data. Now, here's the thing. Why am I talking about recession? Unfortunately, we need recession. We need recession because we need to reset the housing. Well, on my channel, we're watching the housing market, but the economy needs to bust. We need to pay for the sins of COVID. And really what I'm saying, you guys, is unfortunately what this means is unemployment. If unemployment becomes unhinged, then everything comes to fruition as far as the crash, the reset, and things like that. The question is, though, we're going in recession. I mean, I'm convinced based on historical precedent that we're going into recession, but the question is how out of control will unemployment get? If unemployment only gets maybe 1-2% higher, maybe we just have a slight additional correction. We already had a correction in last year, but if unemployment goes up 1.5, so maybe it's not going to hurt that much, right? Still, though, something's going to happen. And I believe it's going to go up more than 1%. But what I want to point out is if it becomes unhinged and say it goes to double, say it goes to 7%, it's game over. All of the bulls, all the people, housing market's fine. It's game over. This data set is one of the most important things if you're waiting for house prices to correct. Because this right here, you guys, unemployment is going to lead the way. And right now, this just updated today. It's showing 3.5, but it updated. Let me see if it's, yeah, okay, there, it's updated now. Okay, so guess what? Unemployment went up. Let me show you guys. Finally, unemployment for the first time since we've been doing quantitative tightening is now higher than it was pre-pandemic. Look at guys, finally, we have hit unemployment that is higher than pre-pandemic. The last time we've had unemployment this high, you guys ready? The last time unemployment was at 3.8 was in 2019, the beginning of the year. You can see that here, February 2019, before COVID, we had 3.8% unemployment. Right now, we have 3.8% unemployment, and we have quantitative tightening. We have interest rates that have doubled. We have the Federal Reserve saying they're going to continue to cripple us and the housing market. And not only that, most of this trash is part-time jobs. This updated today. We are now at the highest level of unemployment since February of 2019. Okay, think about what I'm saying. Now let's move on. That was the recession thing. Hope you guys like that one. Went all out on that one. This is, okay. Now this next data set, you guys, you're not gonna like. This next data set's important. I'm hopefully gonna expel some rumors here. We're gonna look at inventory. I'm worried I'm gonna lose my dollar bet. Okay. Probably next year is what I should have said. But you guys, here's the inventory. It did update yesterday. We're sitting at now, unfortunately, 669,000 active housing units. Again, you guys, that is up month over month, but year over year, it's down. Last time this year, we had 726. We're at 669. Okay. So what this is saying is when the rates went down in March, it messed us up, messed the housing market up. Remember that the equity was built this year because low interest rates and the crippling effects of the injection of the $400 billion in quantitative easing, okay? Which is to say the bank runs, man. Dang it. So many people forget that. Really hurt my soul. But what I wanted to point out is what I think is extremely important. I think there's a lot of misinformation out there, you guys. There are so many people that try to scare you into saying, just buy a house. Who cares about the unaffordability? Who cares about we're probably not going to get equity for a long time? Who cares about that? Just buy a house because we're short 4 million houses. Have you guys heard that ridiculous nonsense that we're short 4 million houses? Right? I mean, everyone heard that? We're short 4 million. But when have we ever had 4 million houses of active inventory? When? When have we had 4 million? You guys, I'm going to tell you right now, okay? We're short less than 1 million houses. That's it. We're short less than 1 million. If we get about 1 million houses right now, total catastrophe. And you guys, here's the thing, like this, I'm going to go back into this. We can get, snap of the fingers, around 1 million listings within a few months. If, again, unhinged unemployment leads to foreclosure, leads to forced selling, things like that, house prices go down. It's a domino effect. Remember, last time, great financial collapse, we had millions of people selling their house, forced selling through foreclosure per year. So all we need is less than 1 million houses. That's it. Not 4 million. The people that are saying 4 million are brain dead. Okay. Maybe long-term stability over 50 years. Okay. But we're talking about right now. And look at this, guys. Look at pre-COVID. Pre-COVID. Okay. Let's look at where we're at in August. Okay. Here's August. Pre-COVID, 2018 in August, we only had 1.2 million active listings. And if you guys remember, and I was in real estate, obviously, through this entire time, the market was kind of getting a little junky in 2008 and in 2019, which means the house market was slowing down. And I'm pointing this out because the housing market was slowing down. Do you hear me? The house market was slowing down, even though we had 1.28 million active units, far less than 4 million. You guys, the people that are saying 4 million, it's not, they're out of their minds. We don't need that right now. We need a less than 1 million. We get less than 1 million. I'm telling you, we get less than 1 million. It's going to be a good day for everyone. And I also will point out, you guys, we're going to do a market analysis. I'll show you in our housing market that as far as Kingwood area, we have more inventory than we've had this entire year. So in my own personal housing market, we now have more inventory than we have had this entire year. Now, what I want to do is let's go into our first video. This first video is cool. The first video is from JP. Well, it's an interview. We're going to listen to JP Morgan Chase and basically how bearish they're being. They're basically saying, okay, this is a bull saying, stay out of the market. Did you guys hear what I said? I mean, this is crazy to me. So JP Morgan Chase, people are going to interview right now that you're going to listen to, is going to warn you guys, stay out of the market. How often do we hear huge suits and huge companies like this tell us, stay out of the market? You guys enjoy. Let me know if you can that the audio is okay.
In August, the S&P 500 is tracking for its worst month of the year. Join us now with a technical look at the markets. Jason Hunter, JP Morgan's head of global fixed income and U.S. Equity technical strategy. How much of was there any too much optimism built up going from the October lows to where we were in June and July, Jason? Did that need to be worked off, and has it happened?
Well, yeah, we originally thought 4,200 would be a ceiling for the S&P, and that was the case for the better part of the first half of the year, up until the economic data started to beat expectations, let's call it from May through August. And what you saw was a position squeeze. People actually got quite pessimistic and underpositioned by the time you got into early May. And that 400-point squeeze, I think did make things a bit too optimistic. You didn't see sentiment measures really get into the nosebleed section, but things got fairly optimistic for where we are within a late cycle environment. And we think now the tide is turning, so we stepped off of our bearish view with the move above 4,200. But as the market started to roll over again from channel resistance at 4,600, some of our technical signals started to trigger at that point, pattern-based signals. So we are bearish going into the fall period now.
Really? You are? Okay. And I was wondering what other technical bells are ringing. I saw the NASDAQ breath was like the worst in history or something. Are there 50-day moving averages that are being breached? What other things are telling you that are notable that you don't see all the time that might indicate a trend?
Well, I mean, if we take a big step back and we look at some of the broader cross-market signals, the yield curve has been inverted for the better part of a year and a half now. Historically, if you go back to the early 1970s and look at the timing of these cycles, generally between 19 and 24 months after the curve inverts, you see your cycle peak in equity markets that then transition into an economic contraction. As we go into the fourth quarter, you're about to roll into that window of time from the yield curve inverting, the time ago that it did. On top of that, from just a yearly cyclical perspective, you look at seasonality. It's well known September and early October are not a good time to be in risky markets. So we put that together with the high frequency pattern signaling that we talked about already from 4,600.
Hey, Jason.
Yeah.
So if all of this is the case, does that mean you should just be out of the market through the end of the year?
Into this.
At the very least for right now, yes, the pendulum looks like it's going to swing back in the bearish direction.
So you'd sell or
You'd
just
sell
not buy?
Or just not? That's what we're trying to figure out. You'd sell, not buy. You'd buy defensive stock. What would you be doing?
So given where we are in the cycle, I'm of the view that you should be underweight and even short if you're a leveraged investor or trader right now. Until we see signs of a bottom, if the market does pull back like we think, now that could be 4,200, that could be 3,800, it could be a retest of the lows at 3,500. Until we see signs of that bottom, I would stay out of the market and in a defensive posture right now.
Heavy. That was JP Morgan Chase. You guys, that was JP Morgan Chase. Oh my God. Oh my gosh. Okay, we're going to move on to the next thing now. And the next thing, you guys, is going to be about purchasing power, because I said in the beginning of this is going to be laced with overwhelming value. So we're going to talk about purchasing power, okay? And I'm going to start with credit. Now, purchasing power, basically, you guys, is credit, income, assets. Because in order to get a loan, unless you're a baller like Jeff M's a baller, he can pay all cash for a house. I'm not a baller. I can't pay all cash. I need to get a loan. So in order to get a loan, I need to have good credit and a few other things. So we're going to talk about credit. Now, you remember when I'm talking about credit, I'm going to pull up something right now. I'm actually just setting it up, that I've been telling you guys, it's credit card game. You got to play the credit card game, which basically is the only type of debt that has something called utilization ratio. Do you remember me saying that? Utilization ratio is a gauge to determine how much you've maxed out your credit cards. Anytime you go over 30% of your credit line, that trade line is going to hurt your credit, guys. So if at all possible, if you have credit cards and you're struggling and you don't have a credit score at 740 or higher, make sure your credit cards are all paid down. Now I'm going to show you the effects that has by pulling up this amazing software called a what if scenario. Now this is analyzing a credit profile, and it's analyzing a credit profile that has 5 different revolving accounts. Revolving accounts is credit cards. Credit cards, revolving accounts, it's the same thing, okay? Again, not school loans, not a personal line of credit, not a personal loan, not a mortgage, not a car loan. Only, as crazy as it sounds, credit cards. The only thing that has it. I didn't make these rules. I think it's awful. But anyways, guys, let me show you what happens when this person pays down their credit cards. You can see that their starting credit score is 663. 663 should be the minimum, in my opinion, should be the minimum credit score anyone has when purchasing a house. Anytime your credit score goes under 660, you start to get hit hard, you guys, with fees and penalties when qualifying for a mortgage. So you want to make sure that your credit is as high as possible so that you're not stuck in a horrible fee game. When I had my bankruptcy repo and foreclosure, I was hit around every corner. I was slapped with a fee. And it's just, life just gets harder. But anyway, 663 is the starting score. Let me show you guys, if she were to pay these down, all right, to $1, let's pay all these down to $1. You see on the right side is dropping her utilization ratio as I'm doing this. Okay, she's just paying down her credit. Why did I not work? Okay, you guys see this? Do you guys see how amazing? You guys getting what I'm saying? I really want you guys to win. I want you guys to win. It is so hard out there. It is so toxic out there. These guys are ready to take advantage of your challenges. These guys are ready to take advantage of your failures. We need to go into this, you guys, as strong as possible, as evolved as possible, with the best credit as possible. And I'm just pleading with you guys to please take into consideration how effective playing the credit card game is. Okay, you have to be responsible, though. You have to be a responsible person, and you can be. But look at her score goes up almost 80 points. Almost 80 points, and all she did was pay her credit card balances down. It went up almost 80 points. That puts her in 4 tiers higher on her mortgage rate. Her mortgage rate will go from crappy to less crappy because she's from 663 to 742. You guys, please listen to me. I don't care if you're Jeff M right now and you already bought a house. Jeff, if your score is not 780, you better be playing the credit card game, Jeff, because I don't care you bought a house. This helps everyone, okay? Let me show you guys now the opposite effect. So if she maxes out all these credit cards, say she goes over the credit line. Let's say she goes over the credit line now on all of them. Let's see what effect this is going to have. And I'll push this out as well. This is, oh, darn it. I don't know if this is going to work, unfortunately. It's not going to work because of the time frame. So you see this little time frame right here? Let's see. Okay, so it only dropped it a little bit. That's really interesting, probably because it's a limited profile. So let me show you guys one other thing instead. 30-day late payment. It is so important I don't care how many credit cards you have. I don't care what if your payment's $5 or $5,000 a month. If you're late on a credit card, it destroys your credit. Let's take this little credit card. This credit card has a $150 balance, okay? Right there. The payment's only $81 a month. That's it. If you don't make this $81 payment, if you're late on that $81 payment, your score goes from 663 to 577. Your score goes down 85 points. One late payment on a little credit card. That's not good. Hope you guys are getting it. It's not good at all. Okay, so that's credit. So what's the next thing we got to look at? Okay, income. Let's talk about income, and then we'll talk about assets. Credit's important. As far as income, listen to me. When it comes to income, if you're on a W-2 job, you're paid hourly, you're paid semi-monthly, you're paid bi-weekly, whatever it is, it's usually pretty easy to use that for a loan to qualify for a house, okay? The thing is, guys, that's the easy part. When it comes to overtime, bonus, commission, second job, or self-employment, you have to have a 2-year history. Remember that. So don't assume just because you got 2 jobs or just because you're working overtime that you can use that to qualify for a house. You have to have 2 years. Don't forget that, okay? Now the next thing, credit, income, assets. Assets, okay? In order to have assets, I generally tell people where you need to start is by rebudgeting, okay? Most, including, I'm talking to myself, subscriptions and going out to eat are usually killers for households. Usually if you guys can just eliminate going out to eat, if you can eliminate half of your subscriptions, you're probably going to save, no joke, well, I don't know your situation. I'll save $1,000 a month. $1,000 a month. Now, one of the best ways that I have found to monitor how I spend my money is by using mint.com. I have zero affiliation with this company. I use it myself, and it has helped me for a decade. Let me show you. This is what mint.com looks like. You basically link all of your credit cards, and your checking accounts to this program, and it will monitor what your credit card balances are, how much cash, how much investments, how much property. But that's all cool. But the thing that I like the most is, well, you can set up your budget too. So I have my own budget. My wife and I have our own budget. So we get to make sure every single month we're on budget. I suggest it. This is free, by the way. Let me see. But this is what I like. Okay, this is, in my opinion, right here, like one of the most important things, which basically tells me every penny I spend. So if I see that I'm spending too much money on subscriptions or going out to eat, that service will actually help me figure out what I need to do to change my situation so that I can better save. All right. So credit, income, assets, and don't worry, you guys, I'm going to do a market analysis at the end of this. But before we do that, let's listen to one more. We're going to listen to one more video. All right. I'm going to timestamp it. 50, 47, 48. Geez, if you guys have been with me this whole time, like, thank you so much. I know it's been almost an hour. Okay. So this is going to be a video on basically the Fed is going to remain hawkish. The Fed, I know the Fed's in control. I know, we all know if the Fed tomorrow drops interest rates to not the Fed, because we know that mortgage rates don't track the federal funds rate, it tracks the 10-year treasury. But say the 10-year treasury drops and it drops low enough to bring mortgage rates to 5%. We know there's going to be a ton of buyers coming back, and it would probably ruin things. So here's the video saying that that's not going to happen, and that's not going to happen for quite some time. Let me know if you guys can that the audio is okay.
Michael Pond, Barclays head of global inflation-linked research, is here to talk a bit about the inflation and fixed income outlook, as well as the economy. Michael, good to see you. We obviously are expecting, based on the consensus, just a little bit of a pause in this disinflation move in terms of core PCE that we've seen for a while. But we also have Atlanta Fed President Raphael Bostic overnight in a speech essentially almost declaring victory, saying if you took out the lagging shelter components of inflation, we're almost at target in terms of core CPI as well as PCE. Where do you come down on this idea that inflation is already largely taking care of itself?
Well, we do think it'll pause, and we actually think we'll get a bit stronger number in the core PCE, especially in the super core. So stripping out shelter within services, we actually think it will come in at a fairly strong 0.5, which is not going to leave the Fed with an impression that they're making continued progress, that inflation, while down from its peak, is still too high. So even Atlanta Fed President Bostic's comments, while the market is taking it as a bit dovish, he indicated that he thinks, again, he's one of the more dovish members, he thinks that they'll be on hold at a high level of rates for quite some time. The market is pricing in cuts as early as the beginning of next year. So we think the market is still bearish relative to the outlook and not fully getting the message that the Fed is keeping at it. That's really been the message since Jackson Hole 2022. That was reiterated at Jackson Hole 2023. And we think that the Fed will remain on the hawkish side until inflation really does come down much further towards target.
Exactly.
I grant that the Fed funds futures market does start to price in some cuts out there, but does that in your mind mean that most investors genuinely expect there to be cuts, or is that just kind of the way we manage risk in this economy? The Fed's almost done, so the next significant move is likely to be a cut, or at least we want to have a just-in-case trade on in the event that the economy weakens.
Yeah, I think that's a really important point about how markets price. Markets don't just price for baseline scenarios, and if they're just above 5, if you think there's a chance of 0 by the end of next year because of some absolute crisis, well, there's probably not much of a chance of 10%. So again, if you're leaning, are rates going to be 5% higher or 5% lower?
Right.
Chances are they'll be 5% lower. But we think that the market is still priced for too much confidence, too much risk of that downside scenario. And we think real short end real yields are poised to continue to move higher as they have been.
Right. What do you make of the fact that we did see a pretty significant rally in Treasury, so yields coming down over a couple of days, based on arguably some secondary economic inputs, right? You had the JOLTS number, which of course is widely watched, but never was front of mind, and then the ADP payrolls data. Does that just tell you we were wound pretty tight, expecting a hotter numbers?
Yeah, the market did sell off pretty hard over the prior weeks, and so was probably due for a bit of a pullback. But today and tomorrow, especially tomorrow, is the main show when it comes to the data. ADP and the JOLTS data are certainly good leading indicators, but tomorrow's employment report, payrolls, but also average hourly earnings. The wage growth has been strong. We think it'll continue to be strong in tomorrow's number, up 0.4, and that payroll growth will continue to be too strong for the Fed to believe that inflation will come in consistent with its 2% target. We're expecting 200 print on the headline payroll print tomorrow.
My business runs on more than just machines.
Things are certainly changing. So we're going to go into the last part of our video, which is how to find a great deal. So I promised you guys that obviously we are going to have overwhelming value. So really you can go back to this live and you can get it. I'm pretty sure you guys can get pretty much everything. And that's really my goal here. Now, here's the thing, you guys. I'm going to show you guys how to do a market analysis, but I'm not saying that right now is like the best time to buy, but I definitely think right now is the best time to learn. Okay. So I just wanted to show you, like, if an investor like called me and said, Travis, find me a deal with wedge, find me a deal with cash flow, I'm going to pull up my matrix. Okay. And let me go back real quick. I'm so sorry, you guys. I'm going to go back here and I want to show you guys what I'm going to fill out. So this is our how to find a great deal. Very napkin math. This is so easy. We can literally in about 10 to 15, maybe 20 minutes, find if a home has wedge and has cash flow. Now, remember, you guys, because real estate is hyper local, we go and analyze the subject property's subdivision with comparable data or comp data. And comp data is sold property. All right. So I'm going to go in here now. We're going to, again, fill this out. But first, let me play like you guys are an investor, because the reality is, guys, I'll buy a house tomorrow. If I could find a house tomorrow that I love with the price point that I'm looking at, which is, we're going to have a lot of wedge. I don't want a little wedge. I want a lot of wedge, and I want to love the house. I'll buy it tomorrow. So I don't have to, my point is, if we're educated enough, and we have to be blessed in a market, like Jeff's not in a market like mine. My market, I can find things. It's just, I don't find anything I love, and I want to find something I love. my market is a market where hopefully you guys will learn how to find a great deal, whether the housing market crashes tomorrow, next year, maybe it lasts for a year or two, whatever it is. This is something that you guys could take away with you. Essentially, I want you guys to have come to my channel not even understanding an amortization schedule, and I want you to leave understanding what wedge and cash flow is. If you guys can do that alone, you're ahead of 95% of home buyers. Those two things, wedge and cash flow, and how like to find the value. I mean, please, this is my gift to you. I really hope you guys are learning. So here's where I would start. So say someone's like, Travis, I'm an investor from Colorado or California, and I want to buy one of these properties out in Texas. Hoorah, right? So the first thing I'm going to do is I'm only going to look at properties with price decreases because I don't even want to play no games. I only want people, honestly, guys, I only want, oh my gosh, girl, Miss Crazy, what you doing, Miss $20? You know what I'm going to do with that $20? I'm going to buy a treasury for my child with that. I'm going to buy a treasury for my little baby girl, Miss Crazy. It's going to be worth $25. I'm going to do it. I'm taking that money. I'm investing. I'm going to show you, Miss Crazy. We're going to use this money. We're going to invest in our children. I so appreciate you. I so appreciate all of you guys. I know it's still a bit early for this, Travis, but can you please make a video towards the end of the year on how to protest property taxes in Texas? It's very intimidating. New concern. So Miss Crazy, I just made a video on that. Go to let me show you real quick. Okay. I got to show her real quick, guys. Miss Crazy, I made a video on that, on how to protest. The video is called, let me find it. Boom, boom, boom. Oh my gosh. Like no one watched this mall video. I almost died at this mall video. Oh my gosh. Can't believe no one watched that. Let me see. Where is it? Here it is. Go to this one. Miss Crazy. This one has it. Okay. The record 18 billion property tax bill. This one has like how to do the homestead. Let me pause it. If you go to chapters right here, look it. So I have chapters. Where's my chapters? Oh my goodness. I didn't put chapters in this. What? I can't believe I didn't put chapters in this. I am so embarrassed I didn't put chapters in that. Anyways, Miss Crazy, go to that. I could do another video, but I have it in there. So go to that video. It's towards the end of the video. Now, again, going back to my matrix, this is my system I can use as a realtor to find properties. So I'm only going to look at homes with price decreases. And unfortunately, there's too many properties. You can't see it because my name is in the way. But there's too many properties. There's over 5,000. So I have to hone in my search. So I'm only going to type in Houston. Okay, I have 1,336 properties now. I'm going to hit results. Again, I only want to see homes with price decreases. So let's hit results. You guys can see that there's 1,343 homes that have had price cuts. Oh my gosh. If you guys don't have a market like mine, I'm so sorry. I am sorry, but I am in a market where I have more inventory than I have had all year, and there's price cuts all over the place. Literally all over the place. I mean, if an investor calls me, this is what I would do. So the first thing, I'm categorizing everything by square footage because I want to find something that basically is, low square footage. So here's one. Okay. This one's $87 a square foot. This one's 2,800 square feet. So let's look at this one right here. Again, if this was an investor. Now, this one's crazy because this one's really, really crazy. So this is the house we're going to do a market analysis on. You guys can see that this was just price cut right here. Okay. This has been on the market for a long time. This has been price cut $40,000 recently. Now, let's look at the condition of the house. I'm going to write down real quick, you guys. I'm going to write on here the price of this. So we're going to do an analysis on this house. The price is $250,000. You guys don't have to really watch this part, but I'm going to put $250,000. Okay, so the price is $250,000. The size of the house is right here. This is really important to get the size of the house. 2,858 square feet. And then remember, we want the taxes. Okay, so I'm going to go down to the taxes. Where's my taxes? Here's my taxes right here. That's from 2021. We'll just use that for now. So we're going to go 3,754 per year. Okay. Now, let's go back into here. And here's what we're going to look at next. Okay, what do we look at next, you guys? Now that we have that, what is the next thing we need to research? You guys should know this by now. What do we need to research now, you guys? Subdivision. Okay, we're going to see how much wedge is in this subdivision. But first, let me show you this house, because there's a reason it's not sold yet, right? Let's see the condition of this house. First of all, I'm just like, oh my gosh, like what? Why is this okay? So so this house is going to need some work. Okay, but again, if there's an investor, they got money, they're going to put in work. Okay, this would be a house for them. But it's got burglar bars inside the house. This is a window inside the house. So I don't know what type of family they have, but my gosh, there must have been some arguing going on in there, because they have burglar bars inside the house, going from one side of the house to the other. Really interesting. Let's look at the condition. But it's actually not in that bad of shape. This is the crazy thing. There's going to be some crazy wedge here. Okay, the floors are all messed up. I mean, it's nasty, right? This is how you guys want to make money. These are the houses you guys buy. You don't buy the super duper nice houses. You buy these junk houses. Oh my gosh, look at this. Is this the central air that they're referring to? Look at this. Was that swamp cooler? This makes me sad, but let's keep going. Look at the crown molding. Something's going on with the crown molding on the bottom, but not too bad. Okay, kitchen's okay. Excuse me. I'm so sorry. Kitchen's okay. Like, I would paint this, right? I wouldn't probably never replace cupboards. Let's keep going. Not too bad. Okay. Here's something that I would be worried about. What the hell is this? Right? This doesn't look good. So this looks like an add-on or something. On the back here, it's missing fascia board. I don't know if this is covering up windows, but this would make me nervous. So if this is part of the square footage, I would be nervous about that. Let me see the agent remarks real quick. Next project, unfinished apartment in the back is ready for your creative at your. Okay, so yeah, this is an investment project. So there is an apartment in the back, so you can actually rent this out. So there's an unfinished apartment. Interesting. Okay, so that's the condition. Now let's take a look at the subdivision. What was the subdivision? Telephone Place Road. Okay, so we put here in the subdivision telephone, because we stay, remember, local. Real estate is about local. So we're going to put our subdivision, telephone, road, place. And we're going to see what houses are selling for in that area. Okay, so going back here. And let's put up this. So I'm just going to go back. And we're going to see. You know what? First, let me do this. Let me just time out the whole system. I crashed the system, of course. Oh my gosh, I'm messing up. So I'm going to go here, quick search. And remember, I only want sold properties. Okay, in the subdivision. What was it? Telephone Road Place. You guys are probably going to freak out when you see how much houses are selling for here. Copy this just in case I have to access this again. So we're only looking at this subdivision. We're going to look at, I only got one sell. Holy smokes. I'm going to put this out, say 400 days. Gosh, 500? Okay, here we go, 500. Let's see what's sold. You guys are, I think you're going to be, your eyes are going to be like blown up out of your head. Look at this. Okay. Again, if I'm an investor, this is something that I want, because in this area, it happens to be downtown, and it happens to be in an area that's actually highly dense. So the average home is being sold for in this area for over $200 a square foot. That home's being sold for, ladies and gentlemen, $86 a square foot. If I had money to burn right now, I probably would buy this house, because I would be walking in with hundreds of thousands of dollars in wedge. Hundreds of thousands of dollars in wedge. Because look at these three properties: Telephone Road Place, Telephone Road Place, Telephone Road Place, whopping $200 a square foot. Let me see what the average is. Charts. Whoops. So you got to select all this. You go to stats, tabular. Average price per square foot. Geez, guys. 210. Okay, so we're going to go back here. We're going to go average price per square foot. Wow, there's going to be a ton of wedge in this property. Okay, so we have that. Now what I'm going to do is we're going to go and figure out the rent real quick. Okay, so we're going to go back. We're going to go to rental market search, quick rental market search. This is a good property. This property that we're looking at right now, it's going to have some serious wedge in it for the last year. Okay, paste, nice. See what we got here. I only got 2 comps. Let me go out 500 days. I got 3 comps. All right, well, let's just see the results. Okay, oh my gosh, this is insane. Okay, so all over the place, actually. Let me look at this house. Conditions decent. Smaller house. When was this sold? This was sold 2022. Interesting. Okay, stats. We don't really have too much information here, but let's look at what the average is anyways. Okay, $1.21 a square foot. So we go here and we put $1.21 a square foot. Okay, so now I have enough information to calculate what the market value would be if I improve that property and what the market rent would be if I improve that property. Because remember, we're starting with the property, and I showed you guys that as far as the back, it looked like it needed some work, but the inside maybe, I don't know, $15,000, $20,000. I don't know. It just depends, but you would have to put in money, right? So if you put in money, then we'll have the market value. So I'm going to show you guys how to calculate that right now. Let me pull up a calculator so I could do this as well. All right, so take a look back here. All right, so the first thing I'm going to do is we're going to calculate market value. The way I do that is by taking the square footage here and multiplying it by the average price per square foot. So 2,858 times 210, geez, equals 680,000. So again, and I looked in the entire city of Houston and I boiled this down immediately. You're not going to always find this type of information. So already I know this is worth my time. So what I'm going to do now is let me calculate wedge, or how much I'm purchasing this for under market value. The way I do that is I subtract 600,000 from 250, and my gross wedge, this is my gross wedge, because remember, I haven't put repairs in yet, is a whopping, y'all, this is one house I would help someone get, okay? If you're interested in this house, put in the subject line of my email, the investment house, because the wedge right here, absolutely ridiculous, absolutely insane. That's insane wedge. Now remember, you guys, this is gross. Okay, so you would subtract repairs, right? So before purchasing this house, I would want to get quotes on repairs to get a better net wedge. But you guys can see, I mean, that's an overwhelming amount of wedge. That's $350,000 in wedge. So now the question is will this property cash flow? Let me show you right now, okay? So in order to figure out if it cash flows, we take the size and we multiply it by the average price per square foot for rent. So again, we go 2,858 times $1.21 equals market rent, $3,458. Now again, you guys remember, this is the gross stuff. If we were actually like super duper interested, I would do a lot more research, but at least now I have my market rent. So before I can complete this, I have to now figure out what my estimated payment would be. So in order to do that, I would call my loan officer, say, hey, loan officer, let me give you this property, work up the payments for me so I know if I cash flow. Goodbye and hurry up. Also, I respect you. Thank you for all your hard work. Goodbye. And then they're going to call me back. They're going to give me the payment. But if you want to do the payment yourself, this is how you do it. We're going to go into payments now. Boom. Okay, so I'm just going to put in mortgage payment. My equilibrium's still messed up because I'm still a little sick. Sorry, you guys. Hope my energy is okay for you guys. I mean, I'm still, like I said, I'm still sick. So we type in mortgage payment in Google, hit include taxes and insurance. Let's put the purchase price in there of only $250,000. Let's say we're just going to put 10% down. Okay, let's say we have good credit. Here's our interest rate of 7.369. We know the property taxes. What was the property taxes, guys? What was the property taxes? You see right there? See why we need that? Because we need that for our payment. So our property taxes is 3754. So 3754. We go back here. We put taxes right here. 3754. Let's increase the insurance because this is Texas and insurance is just more. I'm just going to double the insurance. Let's just say $1,700. Okay. I'll have an estimated payment right here. This may be a really good one. Okay, so our estimated payment, we go back to, let me see here, this and our estimated payment. This is crazy. 111. Right now, this is one, honestly, guys, if I had $100,000 extra that I could just throw into something and I could still get my primary residence, I would literally drive out to this property today. Because I'm like, okay, is the 2,800 square feet that they're saying on the listing, is that part of the apartment in the back? That looks like it's all messed up. I don't know. But let's figure out cash flow. And the cash flow right now is bonkers. Okay, let me move my picture. So in order to find the cash flow, all I'm going to do is take this market rent. And again, this is gross minus the payment. Okay, where's my calculator? Which equals minus 21111. Unbelievable. Gross cash flow, 1,347. Now, obviously, guys, I just went through 6,000 properties. And how long did it take me to find this? We went through 6,000 properties and we found this, okay? Cash flow gross, look at that. That is insane. Now, obviously, don't forget, you have to subtract like management fees, right? And maintenance, right? So to get your net. But to start out with $350,000 wedge and a potential cash flow of $1,347, you guys, I'm just saying, hope you guys are learning. Really hope you guys are learning because you're going to need to because I forgot to put a timestamp on that. So I'll have to see where I started. But anyways, guys, that's going to conclude this. I just wanted to do something special. Obviously, I'm not going to get as many views when I do a title and thumbnail like I'm doing. But I wanted to see, I wanted to give you guys, the core people, the people that are really listening, a tremendous value. And I hope you guys found that today. And remember, you guys, remember what luck is, right? Remember what luck is. It's opportunity plus preparation. Without preparation, opportunity is lost. Don't forget that. Don't get comfortable. And also do me another favor if you can before I go. Help other people. Help other people. Educate other people. If you see people stressed, help them. Because again, you guys that are listening, if you guys are getting some of this, you guys are ahead of 95% of people out there purchasing. Understand how much power you have now with just education. Biggest enemy in this industry is an educated consumer. So I hope we're making it an army. Now, other than that, guys, I absolutely appreciate you. Thank you for the support, you guys. Let me pull up these real quick. Vegas, I appreciate you, brother. He's talking about hacking amortization schedules. You guys want to be careful. Amortization schedules are horrible. Thank you for the support, Vegas. Again, Miss Crazy, thank you for the support. I absolutely love all of you guys. Hope you guys have a fantastic Friday. I'll get back, to normal lives and normal videos in a minute. But, again, I've been in bed for the past 3 days. My mind wanders. I get extremely creative. I'm looking forward to not wearing this in our next live. But other than that, have a great Friday. And if you're out there investing in real estate, you guys know I wish you luck and I hope you